Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, regulatory landscape, and capital markets. This segment is presented by Charles Schwab. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq Market site, we have Max Cabasso, Managing Director on the Nasdaq Market Intelligence Desk, Michael Normyle, U.S. Economist at Nasdaq, Mao Dong, Head of Portfolio Research at PGIM Multi-Asset Solutions, as well as Bobby Eng, Senior Vice President and Head of Platform and Institutional ETF Distribution at Franklin Templeton. We're here to discuss the structural changes investors are navigating and where the capital is being put to work based on fund flows. It is great to have all of you with us. Welcome to Trade Talks. Now, it's interesting, this environment has been characterized clearly by sentiment-driven market performance. So how should investors be thinking about all this as we head into Q4?
Yeah, Joe, and thanks for having me here. This year has been an extraordinary year, but also a year characterized by a lot of uncertainty. And it's really kind of tested our traditional view of the relationship between macroeconomics and investment policies. And so as we head into Q4 and really the rest of 2026, we would advise our clients and investors to be exercising caution and risk management. On one hand, you have still a ton of uncertainty on a macroeconomic front. Trade politics and policies are still uncertain. Tariffs, they're questioning the legality of the tariffs in 2025. You still have a weakening labor market in the U.S. You have geopolitical tensions, and globally, you have a lot of political turbulence as a result of fiscal budget issues. At the same time, financial market is priced for perfection, with equities hitting all-time highs and spreads at multi-decade tights. And so we'd advise exercising caution, risk management. From an allocation perspective, we would focus on high-quality carry income. I would say that the relative value between stocks and bonds have really trended below historical average, and so that would favor more income-oriented strategies like fixed income, and within credit, really focusing on higher quality credit, just given how flat the credit curve is.
Yeah, and Bobby, well, you know what? Despite this backdrop, there's been tremendous growth in ETF flows this year.
Yeah, absolutely. I mean, speaking of all-time highs, that's no different when it comes to exchange-traded funds. The entire global marketplace is now sitting at $18 trillion worth of assets. There's 15,000 products globally. There's 30,000 listings, over or close to 900 different ETF providers in the marketplace, and that's 80 some odd exchanges and over 63 different 63 different countries. If you include this month, so that'll be 77 consecutive months of positive flows going into exchange-traded funds on a global scale. So that's, if you do the math there, that's over 6 years of positive flows going into ETFs. The U.S. has the vast majority of those assets and those flows at probably closer to about 70% of those flows and about 7% of those assets. They brought in about $1 trillion this year alone, and you're looking at $12 trillion worth of assets in the U.S. I'm from Canada, so from a Canadian point of view, I mean, another record year, right? So we're looking at 80 or $87 billion of net flows going into the marketplace, 200 new products, 1,800 total products if you look at both exchanges in the Canadian marketplace.
Yeah, which is interesting, Max, because I mean we question it daily on the desk, the valuations and just how much more juice is left in the U.S. markets.
Yeah, and we've talked about it frequently about kind of where those flows are going. It's into that growth, tech, mega cap trend, and we had a note out a few weeks ago, kind of wrapping up the previous quarter, and the market's always going to find a wall of worry, to climb. The chorus is starting to get louder, though, talking about those concerns. Just valuation of stretch, historical averages, and kind of the underperformance and lack of breadth. We've started to see, perform a bit. Russell finally hit all-time highs again after however many years waiting for that to happen. So I think the backdrop of the current rate environment, if we get additional cuts, we had the minutes that came out, everybody kind of supported it, was unanimous in lowering. So the backdrop is there, but there is definitely that worry, just the sheer concentration and the size of how, again, concentrated the ETFs are. Broader market, S&P, the Qs, it's really that tech-focused mega cap trade that has continued to work. And it's been tough to get away from that because you're sitting there if you're on the sidelines or have been in small caps or in bonds, you're sitting there looking at the market. Despite the worries, continue to press to new highs. So it's been difficult to get away from it, but you're hearing a lot of those worries. Is that going to happen? And will it be prolonged? We talked about we've had these pullbacks. Obviously, you look at the April lows, but everything kind of has snapped right back. We haven't had any really prolonged drawdowns in that trade, so investors have been, rewarded for going back in, buying every dip, and that trade has continued to work. And that's where, again, that's where the risk comes, is that it's just so concentrated, and the amount of investors that are in that single trade, if it turns, it can be violent on the way back down.
Right, and the thing is, there's such a dichotomy, it feels like, between the market and the economy,
For
which,
sure.
Michael, brings me to you, because with the government shut down, data has been unavailable, so economists and investors are looking towards private resources of data. Is there anything that you can glean from it that either suggests we're running on all cylinders here of the economy, or there's some slowdown concerns?
Well, I think the trouble with private data is you're just not going to have the same kind of sample that the government data is. It's really the gold standard for economic data, and unfortunately we're flying blind a little bit here. We were able to squeeze through one more week of jobless claims data based on state level data that had been released even after the government shut down, and that was really telling the same story that we've been seeing, where layoffs remain really low. And then we also saw the PMI data for services, and that was actually kind of mixed messages from the S&P and the ISM PMIs for services. But where they did agree was that their employment sub-indexes were in contraction. So they raised a little bit of cause for concern, but ultimately the only problem that we have with the labor market is with hiring. The layoffs piece is not really a concern. And so that's where it makes sense that the Fed is making these rate cuts. It seems like we're going to get 2 more. The government shutdown probably makes it likelier that we get a rate cut later this month. So I think it's going the right direction to support the economy, and hopefully, as that uncertainty you're talking about diminishes, that might help with the hiring as well. So you put a couple factors together that might keep the economy in this expansion, hiring picking up, and then the economy picking up into 2026.
I think also part of jobs not being lost but not being hired could equate to what types of jobs companies need to hire for, as we're in this AI limbo and trying to understand how exactly are we going to leverage this type of technology?
Yeah, no, and I mean, part of the hype on AI is kind of the limitless kind of possibility and application it has. I think, first and foremost, the application of AI on efficiency, building efficiency, whether it's more on kind of data gathering, data synthesizing front, is going to be most apparent. But the broader application of AI is still wait to be tested, and that could cause some sort of market reaction if it doesn't pan out to the extremely high expectations that the market has set for it. And so, again, that's why we're advising clients to exercise caution, risk manage, maintain balance. AI also has made its way through peripheral credit markets, right? And if you think about the infrastructure that's supporting AI, looking at innovative financing solutions, that's given rise to private credit, asset-backed finance, right? You hear of these terms in the headlines all the time, but is the collateral backing those? These are kind of really built up from the hype around AI, and so this is something that we're watching for. It could bring balance to the broader hype over equity markets as well.
Yeah, well, let's talk about the emerging markets for a moment here, Bobby. I mean, some of them have certainly outperformed U.S. markets this year. Where are you seeing flows? Where is it standing out?
The emerging markets, we're seeing lots of flow and lots of interest into emerging markets. I mean, we see a rebound over the past 4 years in emerging markets after the U.S. big run up. Emerging markets is doing significantly better than domestic markets. Over 30 some odd percent year to date relative to the U.S., roughly around 15, and certainly. And also better than the Canadian marketplace, roughly around 20 or some odd percent as well. We're seeing lots of interest in various different countries, in particular looking at China and Japan, China, we're looking at India, South Korea is also, we're seeing interest there. And it's quite interesting because, I mean, and it's quite striking because if you compare it to the US marketplace, and you mentioned this earlier, Max, you see these outstanding all-time highs over the past 4 years. The U.S. has seen all-time highs 160 times. That's actually a correct statistic, 160 times. And whereas emerging markets just recently hit its all-time high over the past 4 years. So the time might be right for emerging markets, and specifically in some specific countries.
Yeah. Well, going back to financing of what we're seeing in the AI cycle, it's we're hearing a lot of new terms as it relates to how these deals are being structured.
Getting interesting. Similar in the digital asset space, you're kind of hearing new ways of doing things, new products. It's just one of those, is new always better, is the question I have. And we talked about it with private credit, like you had mentioned. We had talked about it a few weeks ago, of kind of where private credit is looking to get investors, targeting retail, trying to bring additional people in. Is it 401ks that get access to it? And it just adds a little bit more caution to me, again, based on historical, we talked about with deals, you know, if you're able to get a piece of it, you don't want a piece of it sort of moniker. It's just more caution because of the structure of it and how intertwined everything is getting, so that if, I don't want to call it Jenga, but because it's obviously not, but if one piece starts to falter, how does that impact the broader ecosystem, given how concentrated the trade is, how many assets are behind it, and just the sheer size of it. The numbers we talk about the spend, you know, projects target $500 billion, $1 trillion of spend. It's like, these are massive numbers, and if one part of that puzzle doesn't equate and doesn't work out, how does it impact everything else? Does that not just take down, you know, bring down stocks, but private credit, like you talked about, other assets that are potentially not as liquid, that you can't really get out of, whereas stocks, okay, we can get in and out quickly, you know, take a bit of a drawdown, but if you're in these kind of longer term funds, are you trapped in there? Again, liquidity is easy on the way up. It's always about getting out. So if one of those pieces start to falter, again, credit risk, how does that impact the broader market, just given the sheer size and concentration of the
I mean,
trade?
you're still throwing around $500 billion, you know, half a trillion here, trillion here investment, you know, and I mean, the market caps of these companies are growing, and the infrastructure hasn't even been built out yet.
Yeah.
And it seems as if it's like, you know, paying Peter to pay Paul, which that's why I think the dynamics are interesting.
Pulling forward. I mean, we saw it on the IPO landscape many years ago, after 2021, 752 IPOs. You're really pulling forward because of the rate environment we were in at the time. Dollars were cheap, you know, we were at zero interest rate policy, so everything kind of got pulled forward. And it's, okay, is this going to continue? And then, you know, you have a 2-3 year period where, wait a second, hold on, we really pulled forward a lot of demand from, you know, potentially 3 years out. It's get pulled forward now. What happens in 3 years? Is that build out and the spending and the investment sustainable to maintain those growth projections? And if it's not, then what happens? Again, does it turn into, now we are seeing some real revenue tied behind it? Are we actually becoming profitable? Are we starting to see real applications here that are useful? That needs to start picking up. If that growth in the actual spend and investment starts to drop, you need to be picked up elsewhere to kind of maintain these valuations.
Yeah.
That's why I would argue like that risk management piece is critical, right? Understanding the underlying collateral, these hard assets backing, whether it's loans or really, you know, these projects, that underwriting is critical, and not try to chase return at all costs, right? By loosening structural protections. You should focus on risk management, making sure that there is full understanding of what you're getting into.
Exactly. Yeah. That's exactly the point. Let's stay on structure for a moment here, because I want to talk about a couple structural trends in ETFs for a moment. When mutual funds versus ETFs, is that trajectory still going to the upside? And then what about ETF share class approval? Starting to hear more about that as well. What's the significance of those two things?
Well, increased growth for sure. Well, starting with the share class approval, there's been approval that's already set in place. Over 30 different asset managers have already filed and working very diligently in order to add their mutual fund class in a separate class into an exchange traded fund. So what that's going to equate to is a simple way for investors to get exposure to the same strategy, but just in an ETF structure. That's going to add assets to the ETF base that's already growing by leaps and bounds, and we're going to see incremental growth. So the SEC has already made that approval. They've made some strides with certain asset managers, and that's going to continue with 30 or some odd other ones as well.
This might sound like a remedial question, but why even have mutual funds then?
It's a good point. I mean, if you look at mutual funds now, I mean, going back to 2018, for example, we've seen $4 trillion of net redemptions in actual mutual funds. But the market in these mutual funds have actually gone up close to $5 trillion. So it's a bit of a misleading statistic to think that mutual funds are still doing quite well. In reality, they're actually bleeding quite some bit. All these asset managers realize this, so what they're doing is they're coming up with different structures in order to, not necessarily stay relevant, but in order to provide, to maintain their assets base effectively.
So it sounds like almost mutual funds, if it's what's called a pension fund by example, they can only invest in mutual funds. It seems as if that would be the purpose that they're around relative to the ETFs could essentially do the same thing, or?
Yeah, I mean, in reality, ETFs are easier to acquire versus these mutual funds. So I mean, it's going to be quite interesting over the next 10 years to see, or not even 10 years, 5 years to see, where that asset base of mutual funds are going to be relative to ETFs.
Yeah, Michael, I want to touch on a point that you mentioned before. Perhaps bad news is good news. Maybe if we do shut down for another couple of weeks, then it makes the case again for rate cuts, or if we do see some pressure in the market. But then it always has to be so nuanced in terms of why we are cutting rates. You don't want to cut it because we want to see 3-4 cuts in a short period of time.
Right, right. I mean, if the Fed is moving pretty deliberately, then I think they're in calibration mode instead of cutting to save the economy kind of mode, and so they're still in. That seems to be where they are. We had a weak ADP jobs number last week that in the absence of the official jobs numbers on Friday took on more importance, and so that's where you get this reaction that the bad news is good news, because now markets that we saw increased pricing for rate cuts this year marginally, week over week, going from about 40 to 45 basis points in cuts over the remainder of the year here. So seeing some signs that the economy is slowing but not collapsing is pushing you in that direction of solidifying these last 2 rate cuts, but not a 50, a 75, anything that would really signal true concern about the economy.
I think the holiday season is going to be a really good tell, and we've spoken about this a number of times. Speaking of private data that we have access to, how consumers are spending, what the shifts are from discretionary to staples as an example, but the ways that they are accessing liquidity. BNPL as an example, multiple types of credit. I think that's going to be key to this as well.
It'll be telling, like the guest we had last week,
yeah,
she's talking about being able to split it and tapping into additional sources to try to be able to afford things. Again, we always talk about it though, it's that kind of divergent economy of, I don't want to call it haves and the have-nots, but those that have assets that have really appreciated in this time to be able to tap into, to continue to spend, to continue to power the economy, whereas that kind of K-shape, the lower half, are really starting to stretch. Now, are they able to make it up? Are we starting to see improvements there? Or does that continue in the trend like we talked about last week of those that were previously really powering, not just those that have that had assets that really appreciated, the kind of paycheck to paycheck that were continuing to spend, had savings and COVID stimulus checks. How do they handle this holiday time and spending? Do we see that spending hold up, or is it really going to be the top 10% that are holding everything up, which then puts you at more risk? Obviously, you want to see a broader consumer spend versus just a few of the higher end spenders in luxury goods versus the kind of staples. That's, I think, going to be a very telling data point heading into the back half of the year. Again, the final few months here.
Yeah, which is so interesting now because some of the retailers have performed quite well. Again, it's always a tale of the tape and the haves and the have-nots within the retail space, which is classically how it's always been. So then we have to start thinking about it not through the lens of the consumer, but also through the lens of earnings as well. Who's going to pass on price to consumer? Who's going to eat it in the margins? Because then you have to also think about, from a communications perspective, how customers are going to view your company if you pass it on.
Yeah, and I mean, this also kind of broadened, I'd say, out into just the lasting impact of tariffs, right? I think there's probably evidence that that companies been front-loading some of the inventories ahead of tariff announcements, so you've been able to mitigate some of the impact of tariff. Now, going into end of Q4 and really into 2026, what is the impact, kind of the cost coming from these trade policies, and is that going to get passed on to the end consumer? That will be telling in terms of what that means for earnings, for retail demand, and so again, exercising caution and making sure there's balance in the portfolio.
All right, appreciate everyone's insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.